When I was earning $5,000 per month at my first job, I was overwhelmed by the investment options I had. CDs, stocks, mutual fund, index fund, real estate, gold. There were too many. I felt stuck and I had no idea how they work and where to start. Today we will look at all these investment options and evaluate them based on all these parameters. I always knew that investment is important. With just 15% return, you could double your money in 4.5 years. And in just 9 years, you could 4x your money. And in 18 years, you could 16x your money. That's how exactly I turned my investment portfolio into 7 figures. And today, exactly 17 years later, I'm financially independent and retired at the age of 41. Out of the $5,000 salary, I decided myself that I will invest $2,400 just for that month, not on a regular basis, but just for that month, I invested $2,400 that month and invested that $2,400 in 6 different investment options. That is $400 for each investment. Stick around and I'll show you exactly how that investment looked today and what changes I would make in 2025 if I had to start back again. Imagine what will happen if you don't invest that $5,000 and just put it under the mattress. Yes, it will remain safe, but it will lose a lot of its value to inflation. But what is inflation? I remember in 2008 visiting Chinese and Indian restaurants and having a good lunch buffet at $8. But today if I go to the same restaurants, the lunch buffet is $25. In simple terms, the bang for buck has gone down in last 17-18 years. And it is due to inflation. More often than not, things are getting expensive because of the inflation. Since 1913, the average inflation rate in the US is 3.2%. And you got to make your money work for you, at least to beat the inflation. That's why everyone should invest. Growing up, I always heard my parents talking about creating more CDs and this particular CD is maturing and we will use this money for this particular use. Yes, CD, that is certificate of deposit, is one of the way to invest money, or should I say one of the option to lose money. It barely gives 3% interest rate, which is often less than the inflation rate. So basically you are lending your money to a bank on 3% and the bank will use the same money and lend out to people for buying cars at 4-5%, for buying houses at 7-8%, and for credit cards at 15 to 20%. So they are making a lot of money on your money, and that's how they make money. If you keep your money in CD, it is a sure shot way of losing your money to inflation. Though on paper you'll see your money grow, but it is practically losing its value to inflation. It is one of the worst investments to me. I did not understand investing and I did not have this much knowledge 17 years ago, so I went ahead and invested $400 into CD, and today the value of that CD is $500. Of course I did not keep it, I discontinued it, but with 1 or 2% interest rate, it would just have been $500. That's pretty bad return on investment. In those days, CDs were only good if you're parking your emergency fund there. For emergency fund, having easy access to it and preserving capital was more important than return on investment. However, in 2025, I think high yield savings account are a better option to keep your emergency fund there because it gives much better rate of returns. In conclusion, though the risk is low, the returns are very low with no dividends. CD is a bad candidate for a long-term investment. Number 2, individual stocks. When you invest in stocks, you partly own the company. Suppose this is Tesla and you bought a very few stocks of Tesla when the company was small. As the company grows, your stock, your shares will also grow, and so will your money. You can always choose to keep it and let it grow more or sell anytime you want. But what happens when the company goes bankrupt? You lose all your money. That's what happened with one of my investment, Pier 1 Import, in 2008. It got bankrupt in 2020. I invested total of $400 in GE, Bank of America and Pier 1 Import. And Pier 1 Import went to zero. Today, the value of that $400 investment is $343. Individual stocks are high risk and high reward game. You can only profit if you could invest in a good company when it is small, hold it long term and sell it when it grows. But it is extremely hard to pick a good company and timing the market is almost impossible. Usually past performance of a company of 5, 10 and 20 years is a good indicator of how the company will perform in future, but not always. Remember Kodak? Kodak was a leading name in photography. They were the dominant player in the film and the camera market back then. But they went bankrupt in 2012 because they missed the digital camera revolution. I would highly discourage retail investors to invest in stocks directly. So don't fall prey to those tips you get from your friends that this company is going to do better in next quarter or next year, and just run away when you hear people talk about options and futures trading. It's extremely risky. But you will say most amount of money is made in the market. How should you invest? Well, the answer is index fund. What is an index fund? Now think about an NBA playoff game. You could bet on just one player, like LeBron James, hoping that he scores most of the points. But what if he has an off night? Instead, you could bet on the entire team whose record has been phenomenal that season. An index fund works the same way. This makes your money less risky since you're not relying on just one player and betting on that entire team. Think about how an NBA team is built. You have owners, coaches, strategies, scouts. All these experts work together to select the best player for the team so that it can perform best at the best level. As a fan, you can just chill, relax, and enjoy the game without worrying about how to form a team. Similarly, in index fund, you have fund managers, statisticians, business analysts, professional traders. All these professionals come together and make sure your index fund is successful and gives great returns. And you as an investor get all the benefits of their hard work without doing any hard work yourself. Of course, you'll have to pay some fees to the index fund, and it is called expense ratio. It is usually pretty low for index fund, in between 0.1% to 0.3%. Trying to pick an individual stock is like trying to build your own basketball team. You might guess wrong and it takes a lot of time and efforts. But with the index fund, you let the professionals handle it. They're like your personal championship winning team, making sure your money will grow over time. Even the best individual investors often struggle to beat the index funds. So why not sit back, trust the experts, and let the team take care of the winning? That's why index fund is less risky, has good returns, it pays good dividends, and is good for long-term investment. My $400 invested in S&P 500 in 2008 has become $1,800 in 17 years. S&P 500 tracks the 500 largest companies in the US. Similarly, we have mid-cap index fund and small-cap index fund. The big difference between these three is the volatility. Small cap has the highest volatility. That means the price fluctuates a lot in small cap companies. In mid cap, it is relatively less. And in largest companies, the blue chip, the large cap companies, the volatility is very less. But in long run, all three will have upward trajectory. Everyone loves real estate. But the only problem is you need to have a huge capital to buy a physical real estate. You have option to go for land, commercial real estate, residential real estate, apartment complex. There are many more. But do you have that much capital to invest? If you don't, there is another option, REIT. REIT. It is Real Estate Investment Trust. REIT is similar to index fund, but instead of buying the company stocks, the portfolio manager will buy a portfolio of physical real estate like a shopping mall, apartment complex, office building, or warehouses. These properties will be rented out to the tenants, and the rent will be distributed with all the investors as a dividend. This gives you a steady source of passive income, and you can sell it whenever you want, just like you sell index fund on the market. If you own a physical real estate, it is not easy to sell it off quickly, and if you need that money right away, you're stuck. That's why REIT is a great option. It is less risky, has moderate return, pays good dividends, and great for long term. My $400 investment in 2008 has turned into $850 today. It trades on the stock market just like any index funds or mutual fund, and there are around 200 REITs which trade on the US stock market today. When it comes to investing in gold, you have two primary options. Either buy physical gold like gold bar or gold coin, or buy gold ETF or mutual fund. You can buy gold bar or gold coins, which are excellent tools for storing value. Gold is often used as a hedge against inflation, and its value typically holds up well during economical uncertainties. However, owning physical gold comes with the responsibility of securing it and storing it properly, which sometimes could be risky and costly. You may need a safe or a locker or insurance to protect it. I would much rather prefer the second option, the gold ETF or mutual fund. These options allow you to invest in gold without physically holding it. A gold ETF works just like an index fund, which we discussed in the past. But instead of tracking the price of a basket of stock, this ETF will just track the price of gold. This ETF will eliminate the storage and security concern and still providing you the hedge against inflation. Gold ETFs are more liquid, so you can easily sell and buy on the market, unlike the physical gold. Now, if you ask how about gold jewelry, well, that is not a great investment option. Gold jewelry comes with the making charges, design cost and other fees, which doesn't make it a good investment, which significantly reduces its resale value. In conclusion, gold has a moderate risk, it has moderate return, and it doesn't provide you any dividend. My $400 investment turned into $1,190 in 17 years. A small 5% of your entire portfolio should be allocated to gold. Remember, this is not a financial advice. This is for education and entertainment purpose only. And the last one, bonds. Not James Bond, but bonds. Bonds is a loan you give it to a government or a company. In return, they will promise to pay you back the principal in a certain amount of time, along with periodic interest payments called coupon. There are various kinds of bonds, like government bonds where you're lending your money to the government, or corporate bonds where you're lending your money to corporates, or municipal bonds where you're lending your money to the state government. But why invest in bonds? Well, it provides a steady income, you can diversify using bonds, and for safety, because usually government won't default on the payments. But the drawback of the bonds are often the returns are very low. Bond prices go down when the interest rate rise. So you may face losses if you sell before maturity. Bond is a low risk and low reward play. You can earn some dividends with it, but it is not a very good long-term growth investment. My $400 invested in bonds in 2008 has become $430 today. If you like this video, I am sure you will love this video which I released last week. Your fired friend Sushant signing off.